when someone's investing with you, they're investing in a few things. They're investing in you as a person, right? They like you, they like your character, they think you're capable. So they're investing in you as a person. They're for sure investing in the deal, right? Even if they love who you are, they're not going to invest if it's not a deal that's a fit for them, right?
Yeah.
And then kind of thirdly, or this is kind of in between, is track record, because they don't know how the deal is going to work out. But if they see that you have a track record, they can kind of in effect invest in that track record, assuming that that performance is indicative of future results, which obviously that doesn't always work out, but it is helpful. Track record is very important. So when you're starting out, you don't have that, and the best way to deal with that is to fix it.
Hi, everybody. Jose Luis Morales. Welcome back to the Morales Group Show. This is episode number 76. Today, we've got a very special guest. His name is Robert Beardsley. He owns over $100 million worth of real estate, mainly in the multifamily field. Today, he's going to be sharing his story with us. He's going to be going over how he built his company from just a two-person team to where it's at now, to over $100 million worth of real estate, going over how he got started in the business, went from underwriting deals to raising capital, and little by little, he's kind of been working his way up. Welcome to the show, Robert. How are you?
I'm great. Thanks for having me.
Cool, man. Thank you so much. Before we get started in the interview, I just want to remind our viewers that if you've enjoyed some of our previous content, make sure to hit that subscribe button. And if you feel that this interview would be helpful to somebody else, make sure to share it as well, too. So I'm excited about this because you're a younger guy. You don't see that many young guys, 24, that have the track record that you have. So just take us to the beginning. How did you get started? Who is Rob, and how did you get started in real estate as well, too?
Sure. So, my start goes back to growing up in Northern California, in a real estate family. My parents ran a brokerage firm. They bought and sold luxury homes for their clients. So they were doing stuff on the single family side, as agents, and also doing some development, construction stuff. So I was exposed to the real estate world
early,
but not necessarily in the most positive light, because, my family, it was kind of a big source of stress, because transactions are stressful, and you've got to run and you've got to make deals happen. You've got buyers, you have sellers. And so my parents didn't want me to be in the real estate business. They told me to go into tech, because I was growing up in Silicon Valley, and you're seeing all these people do really well in the major tech firms as well as startups. And so they were pushing me to go in that direction. And which I did initially. I went to school for computer science, but then while in college, I was just kind of doing research, just being intellectually curious and studying a bunch of different things. And I essentially circled all the way back to real estate, and more specifically multifamily, because I was always really fascinated by investing, passive income, delayed gratification. If you kind of boil things down to the most successful way to live life, it's delayed gratification. Whether it's doing your homework so that way you can get a good grade, which is good for the future, right? But eating that candy bar today is way better than the homework. So that delayed gratification has always been something that I really latched onto and liked. I like putting in the work and then reaping the rewards. So investing is that's a great manifestation of that. So found that kind of passive income desire, found that multifamily was a great vehicle for passive income, much more so than single family, because while you can own a single family rental, there's a lot more challenges for scaling and really making it into a real business. I mean, obviously that asset class has been institutionalized over this past cycle, but nonetheless, I saw kind of the stresses of the single family aspect from my parents, and thought that multifamily was kind of this paradigm shift into a more sustainable, scalable, long-term thing that really made sense to invest a lot of effort into. So started working on that. I mean, little did I know, it's like every business that you go into is going to be stressful. And like we were talking before we went live, being an entrepreneur, you have to wear every hat and do all the aspects of the job, right? And that's just the nature of the beast and the way to get started. So in college, I started actually pursuing it. Wasn't necessarily planting my flag and starting a business or anything. I was just kind of going through the motions, right? And that's the amazing thing about real estate is it's a very like community oriented business. It's a very deal driven business where, you and I could partner on a deal and just kind of try each other out. If we like it, we could do another deal. If we don't like each other, we don't have to do another deal. So it's not like, you're going into business forever. So that's a great part about real estate getting started. So that's kind of how I started my business essentially while still in college.
Okay, so you were in college at the time, and that's kind of what did that look like? Like, meaning, like, did you have a mentor at the beginning? Did you stumble across a book and the light bulb just went on? Because I know for me, the light bulb for multifamily didn't go on until 10 years of buying single family. And I hear a guy on a podcast saying, buy multifamily, buy multifamily. I almost feel like you had this ability to be able to see the future a little bit and got into it at a really young age. Do you mind kind of going over that a little bit?
Yeah. So, I mean, just as you kind of found that epiphany through a podcast, I was reading everything I could on Bigger Pockets. I was listening to podcasts, and that was what was aligning me and kind of figuring out where I wanted to go, which, super grateful for. And that's really helpful to be able to have access to that information. Obviously, that's great. And the inspiration, that the even more important part about this idea is the fact that I was young and young enough to be naive and think that I could do it. Right. Because I mean, to make the direct comparison to, for example, my dad, really hard worker, successful, he doesn't think he's successful, but he is. He's a very, humble guy, but in his mindset, right, he's been doing the same thing for so long, and he's been living his life and running his business a certain way that he couldn't really see the other options, right? But I was young enough, had no experience, had the naiveness to be able to think, oh, well, yeah, I can do multifamily and I can buy a 200 unit property, right? Why not? Right? This is what makes sense. So then I'll do what makes sense. So having that aspect to kind of be willing to jump in with 2 feet was really valuable. And even looking back on it now, I kind of think, wow, like that was a big risk I took. I mean, I don't know if I'd take that risk today, right? I know too much now.
That's so awesome, though. So it almost seems like it was a little bit of exposure, like being exposed to obviously seeing the way that your dad built his business, seeing that maybe that wasn't the lifestyle that you wanted to maybe, or the type of business you wanted to run. I had the same experience. My parents were business owners, but my dad wasn't really a business owner. He had a high paying job because the business could not run without him. So I'm almost like in the same boat as you, where I saw that allowed me to see what I didn't want. And now I'm building the actual business. However, a lot of people, when they see you in a position like you're in now, they don't see everything that you had to do to get there. So take us back to, like, what did your first deal look like? How did you stumble across it? Or it doesn't necessarily have to be the first deal, maybe one of the first deals. And what did your team look like at that point, and how has that evolved over time?
Yeah. So the first few deals were all about obviously learning and being willing to, essentially sacrifice and swallow my pride to get deals done. And it's super worth it and I'd always tell myself, because basically the idea I'm trying to get at is when you're doing your first deal, you're inevitably going to need a lot of partners to help you because you don't fulfill all the different requirements of the deal. So you need to bring in various partners that do fulfill those requirements, right? And they look at you as inexperienced and ready to be taken advantage of. So, which is fine. And every time that myself and my business partner which I'll kind of share that business partner story, but we were giving away pieces of the deal and kind of making these agreements, I would just tell myself in the back of my head that
it's okay.
Hey, if I had to pay money to do this deal, it's worth it.
Yeah.
Right. Like, I'm learning and getting paid. This is incredible. So I just told myself that. And even to this day, I do things where it kind of sucks how it worked out. But I just say, you know what? I'm getting paid to learn. So it's okay. So that was a helpful mindset to be willing to bring in the partners, to be humble and go through that process. And so but yes, rewinding a bit to meeting my business partner, which was very helpful. Because obviously starting out, obviously I lacked experience, but the other thing I lacked was a network. And I'll say in real estate, it's really important to have a network, but probably in any business, it's critical to have a network.
Yeah.
So with that being said, being young and not having that established network was very challenging. So what I did was I leaned on two main people to make up for that deficiency. I leaned onto my parents and said, "Hey, you guys are older. You're established, in your business. You have clients and stuff like that. So lean on them." And then at the same time, I leaned on my business partner, who I met at a real estate conference. We clicked, and we were looking at a lot of the same deals, same multifamily deals. And so he was quite a bit older than me and had an established network. He's been operating in the professional world. So I leaned on those two networks to be able to now start building my own relationships with them, and then also allowing me to go and make new relationships. So that's a lot to say. Basically, that's kind of how the first deal looked. But the first deal that my business partner we actually acquired was a 261 unit property in Houston, where we took this huge leap of faith. We had no idea what we were getting into. We had to raise a ton of money, and we were thinking, oh, how hard could it be to raise $4.5 million? And of course, every single thing that could go wrong went wrong. All these things that we didn't know happened, right? That we didn't know would happen. And it's better if you can learn outside of that situation. But if you have to learn on the go like that, at least try to minimize the mistakes and try to maximize learning. So that's kind of what we did. And turns out that raising money was very difficult. Neither myself nor my business partner were really kind of interested or had agreed to take the lead on that front. So neither of us was kind of that clear person yet, where later down the road, we had kind of made it more clear that, okay, I'm going to be the one who's going to focus on raising debt and equity and focusing on the capital side, and he would focus on the operations. So back then it was kind of like all hands on deck, do what you have to do. And, like I said, going back to the partners, we scrambled to really try to partner with anybody. And I it's such a tough experience, but anybody who's listening, who's thinking about doing this, be prepared to absolutely crush your ego. And at least this is the way that I did it. And I pretty much had to talk to everybody I knew and ask for intros from everybody I knew, to just try to talk to anybody and get through all these no's to potential yeses. And eventually we got it done, but it was much, much, much harder than we thought.
Stressful as well too, I would imagine. The good thing is that, like, you made the commitment to basically jump into the deal. And a lot of times people, like, had you known that it was going to be that hard, maybe you wouldn't have jumped in. But the good thing is that you did jump in. My second deal, I went like $40,000 in credit card debt as well too. And like, I didn't have the money, and it almost like lit a fire underneath me that I needed to raise that amount of money to be able to close in 2 months. And I kind of did all kinds of stuff to be able to figure out, which it sounds like you did the same exact thing, which is you made the commitment first, and then you kind of figured it out, or you kind of went, it worked out in the end, it sounds like, by being able to do that.
Yeah, no, it did. And like you said, very stressful. And probably if I knew the full extent of what that would entail, I probably would have said, you know what, maybe we should try a smaller deal first, or maybe we should work on building some relationships before we dive in.
Yeah.
But yeah, putting your back against the wall is a great way to go. And when you're young, it's a fine time to take risk.
How did you know that was a good opportunity, or was it a good opportunity looking back at it now?
Great question. And that's a great segue to kind of underwriting, which is a big part of kind of who I am and my message and whatnot. As you might know, I wrote The Definitive Guide to Underwriting Multifamily Acquisitions, really popular book in the space. I don't know how I was lucky enough to have the idea to write this book and have it, because because you would think there'd already be a book out there just like this. But the funny thing
Yeah.
is, and for those who don't know what underwriting is, it's exactly what you're asking is how do you know what a good deal is, right? And
Yeah.
we don't buy deals based on the color of the paint or how pretty the buildings are, right? We buy based on the numbers. So underwriting is all about the financial analysis of the deal and projecting a certain return. And so starting out in my underwriting career, I just started underwriting deals, deal after deal after deal. Did I really know what I was doing? Maybe somewhat here and there, but just through the process and the repetition and getting feedback. That's the best part, or the most important part, is not just doing something over and over again, but doing it with a feedback loop where you're actually learning from each rep. And that's what I was doing by underwriting deals, talking to brokers about it, talking to lenders, talking to potential investors, getting criticism or feedback from all these different angles to improve my process, improve my financial models, and my understanding of the business. And so I had gotten a ton of reps prior to that deal. I don't know if I had gotten to that 1,000 yet, but had to be definitely a few hundred at that point. So I had the ability to underwrite and understand the financials of the deal. And then you're asking me, how did I also, more specifically about that deal, how did I know it was good? The same process that I was doing for all the other deals as far as getting feedback from everyone, right? Potential investors, service providers, lenders, everybody, you get that feedback and they can kind of edit, massage your numbers, guide. Yeah. And so we did know that from all that feedback that we did have a good deal in our hands. But on the flip side, something that is really interesting and challenging and something that I would experience in a much bigger way on the next deal is that even if you have a good deal, investors are going to turn you down for many reasons, right?
Yeah.
And being turned down over and over and over again, which you will be, you start to question yourself and you start to wonder, well, is it actually a good deal? Or maybe the investors are right, And so there's those doubts and things like that. So that is another kind of thing that you have to battle and fight. Like, you don't want to be blind to feedback and just say, no, I don't agree with you. I know what I'm talking about, right? So you need to be able to let in the feedback, but at the same time, you can't let all the rejection get to you in a negative way.
Yeah, I agree 100% on that. So the first deal, you mind going over, are you guys still in that deal? Did you guys end up selling that deal already? Or what does that look like?
Yeah, I don't want to share too much because we're actually in the process of selling it right now.
Okay, cool.
So, maybe we redo this in a little bit in the future, and I'll have a better picture to share about the full story.
Full picture of the story. Okay, that sounds good. So let's talk about your partner. Was he somebody with experience already, or were you guys on the same boat when you guys were starting off at that point? And how did you determine that? I know that you guys were looking at some of the same deals. How does somebody go about maybe selecting somebody to work with in that perspective?
Yeah, so he was fairly similar on the experience level. He had partnered on some deals as a minority partner, so he had a little more experience and certainly more relationships from that perspective. So yeah, but we were relatively on the same page, which is a good thing. I mean, it'd be nice to have somebody who's a lot more experienced, but then you're not really going to be a 50-50 partner, right?
Yeah.
So we were really fortunate to kind of have found each other right at that right time where he was looking to quit his day job. I wasn't looking to leave school, but I was given the excuse, so I took it and I took that risk. So we kind of both left our stable situations and jumped into the business together, and we're able to that's a very stressful thing for both of us. I mean, for him, much more, right? With a family and the career and everything. So, I mean, he has to get a million times more credit for doing what he did and suffering through that difficult period of uncertainty and, I would say stress and uncertainty. And even today, him and I, we joke about, I don't know, you could say joke about failure, but maybe we're not even joking, right? Failure still scares us, and we still look at, we're growing and growing, but when is it going to all come crashing down, right? So we want to make sure that we're always doing the right thing, always working hard, always continuing to push forward, because if we're not moving forward, then we're probably slipping backwards, and we don't want to do that. So anyway, that's a tangent. Sorry about that. But going back to our partnership, being able to connect like that was good because we were able to be 50-50 partners. And what was unique about it is kind of the age gap. It was such that like I was young and willing to work really hard and willing to make up for everything I didn't have, which was great, because he was older and had some more experience. So we never argued. We've never argued to this day. And I think that's just based on respect, right? And so, I don't know. We're just really lucky. I can't boil it down enough, but sometimes you just get lucky like that and find the right fit for a partner. But for what I would say is, I think that's not really a good idea to just kind of meet someone and then, start a business and partner, right? So what we did wasn't necessarily a great idea, but at the same time, we weren't super irresponsible about it, right? Like we started by meeting, having some conversations, meeting again, deciding to work together. Like I said earlier, we were dating. We can start working on a deal, and we don't have to marry each other yet. So I think from that perspective, we're not totally irresponsible, but just jumping together and doing it, starting a business.
It sounds like there was a little bit of luck, but also it was just two really good people that wanted to better themselves and wanted a better future and wanted to do something great together, which I think that's probably one of the key ingredients, just making sure that the other human being on the other side is just a good person. And obviously, sounds like that's one of the key ingredients. So I know you have your book. Obviously, if you write a book on underwriting, it would be kind of foolish for me not to kind of dig in a little bit as to what your underwriting process is like. I own real estate multi-units in California, but I've never gone out of state. And the main thing is I don't know what a good deal looks like. I know how to identify a good deal down here just because I know the price per doors. I know some of the rents. What is your process, or what makes your process unique as it relates to the underwriting, or what makes your process so good as it relates to underwriting properties? And is there any tips that you can give somebody like me, or maybe somebody watching in that regards?
Yeah, so I would say there's probably not a ton unique about our process, which I'd say is a good thing because there really is not that much magic involved here, right? We've got, like you said, we've got pricing, we've got rents, we've got expenses, rent comps, sales comps. It's not so hard to put it all together. It's just the key is actually doing it and doing it right. And not getting carried away with the numbers because the broker's telling you that rents can be raised $200 and things like that. So our process, a lot of people are surprised to hear that we don't have like a preliminary underwriting process. So for us, we pre-screen deals, and if the deal fits into our general category based on location, age of the property, and kind of the story like that, then we'll dive right in and do a full underwriting. And so, the uniqueness or the magic that you alluded to is kind of in my underwriting model, which is just a simple Excel spreadsheet that I've built over, probably spent over 200 hours building and rebuilding. So it's really refined and it works, just the way that we want it. And the magic about it is it's not the most sophisticated model. It's not the most detailed, but what it is it's the most user friendly. And my goal with the model is not to have the most information. It's to have the most robustness with the least amount of inputs. I don't want you to have to input a million different things just to get the answer. I want you to have to input as few things as possible and then still get the accurate answer. So that's why people love the model that we use and use it themselves. So my underwriting model is available for free on our website, and we've had thousands of investors download the model to use for themselves. And that's great because it's awesome to see that. And then also it's great because people reach out to me and they say, hey, this is broken in your model. Can you fix it? And I say, hey, thanks for picking that out. I'm going to fix it. And so, we're kind of crowdsourcing, improving the model and whatnot. So that's good too. So that's kind of the magic magic's not a secret. Obviously, thousands of people have it. So it's at the end of the day, it's not the model you use, it's how you use it. And so it's going into kind of some of the more complicated stuff about rent comps and debt assumptions, deal structures, and things like that.
What would be some of the inputs? I know that you said that the least inputs, the better, or at least that's one of the things that people like about it. I would imagine that those inputs are probably the most important things. What would those look like? Like, what type of inputs are you looking at to analyze the deal?
Sure. So some of the most important ones are going to be your pro forma rents. That's an easy one. Sorry, did I lose you for a sec?
Okay, yeah. Yeah, it kind of jittered out, but I'm still here.
Okay. So, the pro forma rents are a very sensitive input where you change and for those that aren't familiar, pro forma just means your business plan or your future, right? So if the rents are currently $1,000 and your pro forma is to move them to 1,100, right? That's your business plan, pro forma rents of 1,100. So moving rents just by $5 is going to really change your numbers quite a bit. So it's a very sensitive input. You want to really make sure you get it right, and you get it right by justifying your rents based on rent comps. And rent comps are really simple as an idea, but they actually can be pretty complicated, right? The simple idea is simply, well, the deal next door is getting 1,100 rents. So if I just do what they're doing, which is maybe, upgraded flooring and backsplash in the kitchen, and then I've got my 1,100. And that's what rent comps are. But where they get complicated is, okay, well, what are the ancillary fees for the other property, right? Are they billing back for utilities the same way you are? Do they have, amenities that are comparable, right? Or is it 9-foot ceilings versus 8-foot ceilings, or, all these different things. So it's all about narrowing it down and making sure that your rent comps are apples to apples. So that's kind of the one main one I'll touch on for the inputs, right? Making sure that your pro forma rents are right. Expenses are expenses. Obviously, you need to do your homework. You need to know what it costs to operate the property. And the way you do that is by having a portfolio that you operate so you know what the costs are, or by relying on a partner like a property management company that can provide you their budgets and what they think is reasonable. So that's the expense side. No real magic there. The harder piece, like I'll skip forward to the end, which is a more challenging piece, is the exit cap rate. That's a really famous input. Everyone wants to talk about the exit cap rate. It's very controversial because a lot of people, because basically what that exit cap rate does is, depending on what you input, it determines what you are projecting to sell the property for in the future. And obviously, if you're projecting to sell it for more in the future, it's, your numbers are going to tell you that it's a good deal. Yeah. Right. So, and that's a dangerous thing because, you might get yourself into a deal that maybe, you overpaid for, or is not a deal that you really want to be in because you're assuming that you're going to be able to sell it for a certain price in the future, which may or may not be true. You never know what actually is going to happen, but on a projected basis, what we try to do is be as reasonable as possible with what our future value is going to be, within reason though, because at the end of the day, we're talking about all these different ways to be smart. But if you're going to be, so smart and conservative and basically take no risk, you're just going to assume a doomsday scenario for everything, then you're never going to buy. You're not going to buy a deal, right? Because there's a million bidders competing against you, all with much more optimistic assumptions. So that idea right there is where the art comes in with the science, because how do we be aggressive while staying defensive?
Conservative, yeah.
Yeah, exactly. So how do we be conservative but push the numbers so that the deal makes sense, without risking losing capital? So that's really the name of the game right now. And those are kind of some of the inputs that we focus on.
Perfect. And then I know for me, like one of the big things is when I'm going outside of the area is kind of like selecting a market. Are you buying all over the country, or is there very specific target markets that you have? And if so, what do you look at something specifically to be able to determine that as well too?
So we are also very focused in our market. we do look at deals across Texas, but we are heavily focused on Houston. 90% of our focus is on Houston. So that's just the market we chose. We kind of started broadly on Texas because we liked the story there as far as landlord-friendly state, no state taxes, lots of good job growth, all that's good stuff. And then within Texas, we found Houston to be a great place for us, and we started to build relationships there. And the momentum carried us to want to continue there. So I always recommend to people to stay focused on a certain market, because if you look everywhere, you're not really looking anywhere. And it takes a lot of effort, to cover a market well, to really see the deal flow, to build those relationships to where you're actually getting the good looks on the opportunities and know what the heck you're looking at.
Yeah.
So yeah, I'm a big fan of being focused.
Yeah. I agree with you. That's one of the reasons I've stayed here locally. I just feel really comfortable. There was an 11 unit that popped up. I bought it without sight unseen because I already knew that it was a good deal. Like, I didn't even have to run numbers. I was like, the only number I looked at was 156,000 a door. I said, in my market, I couldn't go wrong there. Everything else is trading at 200, 220 a door. So I knew that it was a good opportunity at that point. So let's talk about how your role in the company has transitioned, because I'm in the same boat as you, Rob. I started off as just a real estate agent. I basically was putting up my own signs, putting up my own lock boxes, inputting my own listings on the MLS. And little by little, my role has been progressing to now I have people that help me in the company. I'm imagining that's the same thing with you. What does your team look like now? And what is your role within the company now? And how has that changed from the time that you got started to now? Because I'm imagining you went through everything that I've kind of gone through, and you pretty much know how to do everything within the company.
Yeah. So like you said, starting out, I have to do everything. So I was underwriting the deals, talking to brokers, sourcing, kind of guiding the vision, doing the marketing. And at this point now, we've been able to bring on, really good contributors to the team, and to help kind of distribute some responsibility, which can help us grow. So I think, so what we did, and I think this is what most people do, is their first kind of major hire is an acquisitions person to help them with the load of sourcing and underwriting deals. So we brought somebody in, and that's worked out really well. He's become responsible for all the deal flow. He's kind of, he's the front man. He's on the front lines. He's doing all the underwriting, talking to the brokers, and submitting offers. So taking care of, took so much off my plate, which is huge, right? Because I was spending hours and hours a day doing all that, and then boom, that's off my plate. Obviously, I'm still involved. We still work together on understanding the deals, pricing the deals, and I have to make decisions like that on the offers. But like I said, it took a lot of time. It gave me back a lot of time. So that was really great. And then that allowed me to invest that time into the marketing side, which was something that, we really didn't have a good handle on our investor relationships. We're a young company, didn't have a track record, didn't have a ton of in-place relationships. So we had to go out there and make new relationships and establish ourselves in the business, right? And so, the way that I went about doing that was obviously like the book, doing podcasts like this, writing a newsletter, which is really awesome, and sending out that newsletter every month, and taking meetings and whatnot. So, all that was kind of where I threw my weight into to be able to really learn and network in the capital markets, right? And so I've become an expert on the debt side of things, and I'm getting there on the equity side. So that's been really important. On the operations side, my business partner, he was driving himself nuts handling everything on the operations side. It's a ton of work. People think like, oh, how busy can you be? You just buy a building, and then the property manager collects the rents, and the maintenance guy does the maintenance, and you're done, right? But there's actually just a ton of work, and you've got to deal with insurance claims, and you've got to deal with hiring and firing, and investor questions, and there's just so much stuff. So my business partner was going crazy doing all that. So we kind of similarly on my side with the acquisitions, we brought in an asset manager that was able to take off my business partner's plate a lot of the asset management responsibilities. And that's huge for him. And that's allowed him to kind of take a breath and be able to focus on important stuff and kind of guide the vision of how we want to grow our business. More specifically on that front, we are actually, as we speak, in the process of rolling out our new in-house property management platform across the portfolio. So, we've been mostly doing third-party management. So hiring an outside company to manage our assets and help with the staffing, all that stuff. So all that is being brought in house. So we're going to be so busy. We're going to go from 5 employees to 25 employees in 2 weeks. So it's going to be a ton of work. And so he's now able to kind of breathe and then, focus on that as we're trying to build out this new brand, Radiance Living, which is our property management business. And for us, it's a really important step in our evolution because being able to have that in-house property management function will allow us to control what's happening at our properties better. And, so control is really important, and hopefully be able to actually be more nimble and optimize the operations. And then the added bonus of that is investors really like to see you have the in-house capabilities. Investors want to invest with a firm that is, has those, has the in-house management and has the nimbleness to be able to make changes and implement the business plan. So that's kind of the evolution of how we've kind of started by doing everything, and now we're slowly peeling back and being able to grow while doing essentially less.
Is the bringing in everything in-house also save on the cost as well too, or is it strictly just for more control and to be able to run the properties better as well too? Just out of curiosity.
So we probably will. I think we will get some savings out of it. It's not the number one reason, but yeah, we should be able to get savings if we do it right. And then, also, right, we're starting a new business, and the point of a business is to make money. So property management companies do sometimes make money. It's really a terrible business, and it's not a profit. Like, the margins are horrible. It's a ton of work, and it doesn't make any money. So nobody should get. I don't know how people do it, but nobody should really get into the property management business unless they're doing it in-house like this to service their own portfolio, because there's a lot of synergies and mutual benefits there. But I really respect third-party management companies that are doing it for just a fee only, because that fee is really small and the work is really big.
We've kind of done the same thing with our portfolio. We self-manage. My admin manages our own portfolio, but we've had to say no to a lot of clients in terms of managing their properties for the same reason that it's a lot of work for the reward as well too. And eventually we might get into it, but for now we're happy just managing our own portfolio. So here's what I was going to ask you. You hired the acquisitions manager. You hired the not a property manager, the asset manager as well too. How any tips or any advice now that you're going to be hiring 25 people? I know that's a big hiccup for a lot of people in terms of hiring the first person. It's a big milestone. Hiring the second person, hiring the third one. For me, it got easier. The first one was like, second one, now we're on our third admin. I mean, it almost feels like I've lost the fear of hiring people and I've seen the benefit. Is there any tips or advice that you can give in that area now that you're going to be walking through hiring a lot more people as well too?
Yeah, so this is something that's really important to me. I think it's one of the most valuable skills, right? I mean, the most valuable skills in the world are sales and management, right?
Yeah.
Being able to manage systems and people is the key here. And so I've been reading a ton of books and trying to get better and understand this stuff better. But for hiring, I think we were really close to this topic earlier. I want to say when we were talking about the partnering up, when it's like two good people, right?
Yeah.
And so it all comes down to people, and I think it depends what business you're in, obviously. So I can't speak for every business, but for what we're talking about, I think it's a mistake to hire for skills, and instead you should hire for aptitude or for personality, right? So because you can hire somebody with no previous skills, but if they have that attitude of, I want to figure this out, I want to help, I want to do the most, that's who you want on your team. So finding that personality fit Our culture is very much like that, where being proactive, figure things out, and go the extra mile essentially. So that's kind of what attracts us to people when we're looking at hiring them is, what motivates them? Are they, one of my favorite sayings is batteries included. We want people who are batteries included, right? We don't need to amp them up. They've got all the energy in them, right? So that's a good one. And the other thing I would say as just a real practical piece of advice is interns. Having an intern is a great way for each of you to test each other out. They can see if they like working with you and they like your vision, and you can see if they can help you with your vision. And speaking of vision, I think that's another really important thing as a small business is people have the option to work anywhere, and if you're, especially when you're talking about a job being a source of income, then you literally can work anywhere, right? That employee can go anywhere to get a paycheck. And as a small business, they can probably get a bigger paycheck elsewhere. So, because I know for a fact, well, not everybody, but most of our people are taking pay cuts to be with us. And I say that because the only reason why they would do that is because they believe in the vision, right? They understand the culture and they believe in the vision. And so I think that is a huge component of hiring is aligning people on the vision and making them believe. And so otherwise you're just not going to really inspire the action necessary to overcome the challenges associated with getting the deal off the ground.
I agree 100% on selling them on the vision. That's so important about getting people on board and keeping them on board. One of the things that worked out well for us too was core values. Like literally, like we started hiring people based on core values, and we have like 5 or 6 different core values that everybody in our company has as well too. But there are things like batteries included, meaning like positive energy, those sorts of things. What I was going to ask you is, I'm imagining that now with hiring a lot more people, there's going to be a lot of systems and procedures that that are put in place. And I think this is an area where a lot of people don't really think about how many systems and procedures have to be put in place to run the type of business that you guys run. Have you guys hired consultants for that? Is that something that you guys just read a couple of books on it? What have you guys gone through to be able to develop these systems and procedures to be able to run a company like yours?
So I'm obsessed with systems. I think they're just so important. I think it's so, the idea of kind of building a system so it can run on its own is so exciting to me. So
yeah,
that is a key component of management, right? Managing people and systems.
Yeah.
And I don't think we're very far away from having optimized systems, very far away. And I think in part the reason why that is because we can get away with it. We can get away without having perfect down to the letter systems when you have great people, right? When you have great people, you don't have to spell every single step for them because they're smart. They're going to figure out the right moves anyway. So, we're kind of spoiled in that way. And I think that is one of the benefits of having the best people, right? Is, pay more for them, but they're going to figure things out and you don't have to micromanage. But going to kind of the hiring thing and consultants and whatnot, the hiring and managing of people that we're embarking on the property management side, where the growth is coming from, those are on-site employees. So those are property managers, leasing agents, maintenance employees, right? And those people do need to be managed more closely because there's just less, it just needs to be run like a tight ship. It's just the way it is. So and we don't know what the heck we're doing. So what we've brought in, a regional manager or someone who has, decade plus of experience doing exactly this. And so we've hired him, and now we're kind of giving him the keys and saying, help us build this, right? Like the only thing we can really do is hopefully share our vision with you. Hopefully you align with our vision, and then, make it happen.
Yeah. What about coaching and mentorship? Like, have you been, is there any, do you believe in coaching and mentorship? Are you part of a coaching and mentorship program? Do you currently coach and mentor other individuals now? How has that played a role in your life, if any, at all?
Yeah, I definitely believe in coaching and mentorship for sure. Both my business partner and I, we started out, in the same mentorship group, which was really helpful to kind of supercharge and learn a bunch quickly, and then also have access to a network of kind of, a built-in network. So that's very valuable. And then today I've, turned it back around and now do, some mentoring on the side as well, on a very private, limited basis. So that is, I think I've seen it work well for myself as a mentee. And then I've also, as a mentor, I've seen, awesome progress happen and go, wow, this is moving so quickly. This is great. So yeah, it's definitely a shortcut.
Yeah, absolutely. Cool. And then when raising money, I know that I've never raised money in my life. Like everything, I've made a lot of money selling real estate. I've taken that money selling real estate and I bought a lot of real estate with it. What I was going to ask you as it relates to that, what are some of the challenges that you guys faced initially, especially as a 20-year-old at that time, 21-year-old at that time? What were some of the biggest challenges, or what were some of the concerns that investors had? And then how were you able to address those concerns and overcome these concerns and get people to actually see what you guys are looking to accomplish and what you guys stand for?
Yeah, there's huge challenges always associated with raising capital. And
Mhm.
especially when you're starting out, you're fighting the lack of track record. And,
Mhm.
when someone's investing with you, they're investing in a few things. They're investing in you as a person, right?
Mhm.
They like you, they like your character, they think you're
Mhm.
capable. So they're investing in you as a person. They're for sure investing in the deal, right? Even if they love who you are,
Mhm.
they're not going to invest if it's not a deal that's a fit for them, right?
Yeah.
And then kind of thirdly, or this is kind of in between, is track record, because they don't know how the deal is going to work out. But if they see that you have a track record, they can kind of in effect invest in that track record, assuming that that performance is indicative of future results, which
Mhm.
obviously that doesn't always work out, but it is helpful. Track record is very important. So when you're starting out, you don't have that, and the best way to deal with that is to fix it. And bring partners onto your team that do have a track record, and that way you can kind of highlight that and say, okay, well, we have a partner on the deal and they're doing XYZ for the deal and they have a track record, so that handles that issue. It doesn't handle it completely, obviously. They're going to want to know what you're up to and what the company and this and that, so it's never a sure fix. It doesn't matter who you are. You might be the most experienced person in the world and raised hundreds of millions of dollars. Raising money is very hard, and
Mhm.
people are going to choose to not invest with you. Irrespective of your experience, and no matter how good the deal is, people just, it's not a fit for them at that time or whatever it is. So there's always rejection no matter what, and that's just the nature of it. So
Part of the game.
yeah, so that's that first piece, as far as getting over the track record hump, is really the hardest part. And so we brought on partners to kind of help fill that gap, and today we still bring on partners to help us raise capital. And because we go to certain individuals or fund managers who, we have a relationship with them, they like us, they trust us, they've gotten to know us, and they have investors, however many investors, but those investors don't know us, right? And
Mhm.
that time to build that relationship is too long. It's too, there's too much of a gap. But if that person who kind of has that, all those investors trust, can convince them, based on his or her
Recommendation.
experience, recommendation, all that, then we can make deals happen. So we leverage those relationships, and that's how we've worked through a lot of capital raising hurdles.
How did you learn to structure these deals? Like, like how did you learn, besides trial and error, how did you learn, like maybe give X percentage to a partner that has the track record? give X percentage of to the people with the money, give X percentage to the property managers. Like how did you learn that part of it? Because unlike single family residences, multifamily is a team sport, meaning there's a lot of different team members involved, and luckily the deals are so big that it makes sense, so everybody can get a nice piece of the pie. Even though it's a 10% of 20 million is a good number. So yeah.
So we learned by just getting involved and talking to a bunch of people and seeing what their offers were, and then kind of we feel what makes sense and compare the different options and learn from different people and kind of see what they're doing on their deals. I mean, one of the best ways to learn actually is just to kind of like snoop around as if you were an investor, right? Looking to put money into one of these larger deals. And because then you get to see how other people manage their process, their funnel, their pipeline, how they treat investors, right? So I definitely spent a lot of time, you could call it snooping, you could call it being intellectually curious, whatever it is, but I would spend a lot of time kind of just looking at other people's deals, acting as if I were a potential investor, not tricking people, but, just kind of looking at it from that angle. If I'm an investor, what happens? Oh, so I get this email, I've got this information presented. Oh, well, what if I were to actually partner on the deal, not as a small investor, but as a major investor? How does that look, right? So learning the different structures of the deal by looking at everybody else's deals is good. And not, some structures are better than others for sure. And so we've learned and evolved our structure as we've learned by partnering with other people, right? We partner with someone, they say, you know what, we actually typically do it this way. And we say, okay, I kind of like that. And then in the next deal, we'll keep that in our structure for the next time. And so, we've evolved that way. Or, you do something and you don't like it and you don't have to do it again, hopefully.
Yeah. It's funny because I actually invested in my first syndicated fund with basically a sponsor for the first time. And it's funny because we received the PPM and a bunch of documents, and I've always bought my own real estate. So now I'm just going to receive a steady return on my money. So it's kind of interesting looking at it from that perspective as well, too. I was going to ask you, I know different companies have different philosophies as it relates to the asset. Do you guys look for more stabilized asset? Do you guys look for value add assets? What is it a combination? What does that look like for you and your company? And has it been the same since day one, or has that changed as your company has grown?
So we look at both styles or both strategies. Like exactly what you said is how we look at deals. We look at deals through two different buckets. We look at deals as value add or kind of buy it, fix it, sell it deals. And then we also look at deals as stabilized cash flow deals. And we like both because both can be good in their own way. And it's all about the risk, right? So if I can get a 13% return on the cash flow deal or a 14% return on the value add deal, some people will pick the value add deal because it's a higher return, but I would actually pick the cash flow deal because even though it's a lower return, it's less risk. And so that risk adjusted return is way better in my opinion. So that's how we look at deals. We don't just pick that strategy and say, I'm buying that strategy. It doesn't matter what it is, I'm buying it. We look at it through the lens of risk, right? So if the returns match the risk or are more favorable, then we want to do that deal. And so what kind of going to your question about how has it changed, just looking back 2-3 years ago, market was expensive, but there were good value add opportunities out there. And so we were buying value add stuff, which was allowing us to create a lot of value, implement business plans, raise rents, raise occupancy, do all that stuff. Today, we're not really seeing the risk adjusted opportunity in that value add space. We love those deals. We'd like to do more. We will do more. But today we're seeing more opportunity in buying stabilized cash flow deals for whatever reason. It's just the way that we view risk. Maybe we think the risk is riskier than how other people are viewing value add risk today. But we see a lot of value in buying in place yield.
Okay. So basically you guys are analyzing the risk as well too, to determine whether it's worth it or not. So what are some of the different factors that you look at when analyzing risk? Because I know like sometimes people look at the reward, they look at, wow, 9%, 10% on my money. But what do you look at as it relates to risk? And maybe what are some of the things that that you didn't look at the beginning as it relates to risk that now you actually, with more experience, that you've maybe learned and look at now?
Yeah, risk is maybe the hardest thing to analyze because it's very difficult to quantify and actually put in numbers, right? You can put the spreadsheet together and say, oh, well, 8% on my money, or 15% IRR, but nowhere in there does it really tell you risk. So risk you have to deliberately analyze through other means, which can be stress testing or scenario testing and things like that. So for us, or in my opinion, just generally speaking, there's 4 sources of risk in deals, right? You've got, and in my opinion, the largest one is debt.
Mm-hmm.
Right? Debt, if you put too much debt on a great deal, it'll become a bad deal if something wrong happens.
That's true.
So debt is the largest source of risk, especially when you're talking about a bridge loan, because bridge loans are higher leverage and
Mm-hmm.
shorter maturity, right? And maturity risk is the most important financing risk, because if your loan matures and you're not in a good position to refinance it or to sell the asset and pay off that loan, you might have to do a capital call or lose money or bad stuff. So you don't want to have, so that's another risk to be appreciative of. So debt is the most important risk in my opinion. Then the other 3 risks are asset, market, and business plan. With the asset, you have risks like to the infrastructure, right? Plumbing goes bad, roof goes bad, foundations, right? That's just infrastructure risk at the asset, which you need a diligence, you need a budget for that. You can kind of take care of that mostly.
Yeah.
And then market risk, also, you can understand well and, buy where there's population growth, right? And buy where there's job growth and lower crime and higher incomes, all those things you want to, find the metrics that work for you as far as the market, right? So that is easier said than done. I mean, it's pretty simple, buying a good market, but at the same time, when you look at a deal that's maybe not in a great market, but the numbers look good, you think, wow, maybe I should go on this one, take the risk. So that's always an art as well. And then lastly, the business plan, right? If I told you I'm doing a deal where I'm going to take the rents from $1,000 and move them to $2,000, you'd have to understand that business plan is a whole lot riskier than buying the deal with $1,000 rents and just letting it cash flow, right? So that's another way we spend a lot. I mean, we quantify risk a lot through the business plan and specifically how much we're increasing revenue. If we are projecting to increase revenue by 20%, let's say, we don't think that's a crazy big risk, but we appreciate that is, we call that execution risk, right? There's risk to getting the business plan to where it needs to be. And if we fall short, the return is not going to be there. On the other hand, if our business plan is just to push revenue a couple percent, if we don't hit it, it's no big deal.
Yeah.
So that's another risk we look at.
That's awesome. This is the last thing I wanted to get into. I mean, what like, how were you growing up? Like, like, were you always like this focused? Were you always this determined? Did you always have goals to do something great? Were you a 4.0 student? Like, just like, what did that look like? Were you in sports? Just to get a little bit in the psychology, because it's not every day that we have a 24-year-old on the show that has built what you've built and has the level of maturity that you have at 24. I know other 24-year-olds that are partying, drinking, and just doing random stuff,
Yeah. I grew up very focused and outcome driven. I never wanted to do anything that was just kind of for fun. I always wanted to keep score. I always wanted to do something that had meaning, right?
Mm-hmm.
And then as far as like homework in school, I would always, get the homework for the week on Monday and I would finish it on Monday. I just, wanted to crank it out. And then growing up, I played football, which I think instilled a ton of discipline and work ethic, and also overcoming injury, being a second string player, being a starter, being benched, all that emotional stuff uh, that is hugely important. So I really value the experience that playing sports growing up gives an individual. So that's awesome. So I think, sports, and then, kind of like an introvert who is very process and outcome oriented.
Pretty much. That's awesome, man. Cool. And then where do you see yourself in the next 5 to 10 years, or what? I know that you've talked about selling people on the vision or having people buy into the vision. What is the vision for yourself? What is the vision for the company as well too? And where do you see yourself in that vision?
Yeah, so we would like to establish our company as a regional owner operator, which I would define as having $1 billion under management. So, and that's kind of, yeah. So if you look at that as about approximately $100,000 per door, that's 10,000 units. So, that's not an easy goal for sure, but that's, it's rinse and repeat. Once you kind of figure it out, you just start adding more assets, and just hopefully it doesn't take 20 years. Hopefully it only takes 5, and then get to billion, establish yourself as a regional operator. And then, it's up to you if we want to, which I mean, I think we will, want to scale it to 5 billion, we could do that, and we'll have to buy bigger deals and have to evolve the way that we operate. But that's all the fun of it. It is certainly about the money. We love making money. You and I wouldn't be doing what we're doing if it didn't pay us, because it's a way to validate ourselves and feel good that we're actually creating value. And there's the money to actually prove the value, right? But to a certain extent, the money is, one thing, but then it's a whole other thing of just kind of like, you accomplish this goal. What's the next challenge? What's the next challenge? And that's the whole idea of going to 100 million, then to 1 billion, and then to 10 billion. So I really love that journey, and that's where I want to get to. But then on a bigger scale, what I'm really passionate about is I like real estate for sure, but what really gets me going about this business is the deal structuring and the kind of the business models, the business plans, the more complex stuff where it's like a puzzle. And I want to expand that idea, or be able to take that passion and put it into other asset classes where things get more complicated, like private credit. Like the lending business is very interesting. So lending for real estate, lending for companies, buying businesses. Those are all things as in the private equity universe that are really exciting. So I'm a big private equity nerd, and David Rubenstein, who founded Carlyle Group, one of the largest private equity companies, he's a funny guy, and he always jokes that private equity is the highest calling of mankind. So I pretty much agree with him, and that's my big goal. Is I want to build $100 billion private equity business.
That's awesome, man. Well, I'm rooting for you, essentially. And I'm so glad to have you on the show. This is the one thing I love about the podcast, is that the conversations that I get to have with people, the exposure that I get as well too. I think my portfolio is like 12 million right now, so it's a tenth of the way of where you're at. But I'm basically talking to a future or a billionaire in the making, which is awesome. I believe you're the second person on the show. Another one owns like 450 some million. That was on the podcast as well too. I see him getting to 1 billion easy, also younger guy. So we're excited about that. I want to say thank you for being on the show. Is there any last and final words that maybe you want to share with the viewers that you think would be helpful?
Well, I really appreciate you having me on, and letting me ramble on and share my story. And as far as the listeners, if you want to learn more about us, head over to our website, lscre.com. I write a ton of articles. I make YouTube videos, which are really educational. I'm not like, it's pretty boring stuff, but for the right person, they love those videos. So people, so check out the YouTube stuff as well. And like I mentioned earlier, on our website, you can download our underwriting model for free. It's just a link at the top. And then if you want to get in touch, I'm active on LinkedIn, posting stuff every day. And you can also get in touch through the investor forum on our website.
I love it, my man. I appreciate it. And then if they wanted to get a hold of you personally, could they find you on Instagram or anything like that? Do you want to share that, like a handle or anything like that?
Yeah, sure. Yeah. So like I said, posting every day on LinkedIn. So I'm super active there, but also on Instagram, more of my, 24-year-old personal life, doing kid stuff as well. That's Rob _Beardsley on Instagram.
Awesome, guys. All right. Well, this was episode number 76. This is the Morales Group show. Rob Beardsley, billionaire in the making, $100 million worth of real estate, underwriting, raising money, everything that you could think of. Super good guy. And thank you guys so much for watching. If you haven't subscribed yet, if you've liked the episode, make sure to hit that subscribe button. And we'll stay tuned for episode number 77. Thank you so much, Rob.
Thank you.